Have you wondered what financial advisors actually think about finances? This is your sneak peek at the conversations within Financial Design Studio. Michelle Smollenberger, the CEO here, will be your host as you go behind the designs.
All right, welcome back to the podcast. I am not by myself this time. I have Rob Stoll with us today, who is our CFA, our investment guru. He is the person who's watching client investments and researching and analyzing things. So, Rob, welcome today to this conversation.
Thank you. Good to be back on the podcast.
I know, we always love having you. So I know you've got a lot going on, so thanks for taking time out to answer these questions. I know they're really important, just with everything that's happening right now. So that's what we're going to dig into today. We know there's a lot of information that's going on in the media. We know we've heard a lot about over the weekend, and we've written a couple of emails, but sometimes a video just brings a little bit more information, just a different way of hearing, sometimes the same thing, but also we just feel like there's a lot of questions that we've been getting, and we really just want to give you good answers so that you're clear, so that you understand what's going on, but also that you can be confident. So we never want you to feel fearful or worried of something that you should be doing that we're not telling you, and so that's really the purpose of this video today. We're going to kind of step back and talk about what has happened. Rob, you've written a couple emails over the weekend to keep us up to date, so thank you for that. And
yeah, no problem. There's so much going on, and we understand from a client perspective. You want to know what's going on. I mean, you watch the news, and the sad reality of kind of social media today. There's just a lot of, I guess, misinformation and a lot of people yelling fire in the theater and all that. And so our goal is always that you know exactly what's going on. What our perspective is on it, and that's why we're really active with writing and doing videos like this.
Thank you. Yeah, so we're going to kind of start with backing up and talking through a lot of what you did put in the emails, kind of explaining what has happened with this SVB bank, the Silicon Valley Bank, over the weekend, and kind of what the Fed has done in response. And then we're going to kind of work from there of, explaining kind of what we've done over the last couple of years, just as we've been watching and analyzing things and just thinking, things don't smell right, and so we're going to explain that, kind of how we work for you, what we're doing, what Schwab does. So really just kind of breaking down a lot of pieces to really kind of break this down to a level so that you understand and you can, again, just have confidence. And then just kind of answer some questions we've gotten to that I think will help you because you might have the same question. So Rob, why don't we back up, kind of give us the big picture of last Friday, I think is kind of when all of this started. We started hearing about this bank, and since then it's been all in the news. So why don't you kind of explain what happened?
Sure. Yeah. So, basically what's going on, just very, very high level is when COVID hit 3 years ago, the Federal Reserve and government put through a lot of stimulus. And they did that by sending people stimulus checks. The Federal Reserve was buying bonds like crazy and injecting cash into the system. And interest rates got down to basically 100-year lows. I think at the lowest, the 10-year Treasury got down to 1% or somewhere around there. And so basically, the way to really understand what's going on right now is to understand what banks do. So banks get deposits, they get all this money coming in, and then they have two choices for what to do with it. They can either go out and make a loan, or if they can't make a loan, if there's not enough loan demand, they just invest it in bonds, mostly U.S. government bonds or mortgage bonds that are backed by the U.S. government. So what kind of happened is all these deposits flooded into the system during COVID. Banks took it in. There wasn't a lot of loan demand because we're in a pandemic, and there aren't a lot of businesses looking to expand in the middle of a downturn like that. So all these banks ended up buying U.S. government bonds and mortgage-backed securities, and because they needed a place to park that. Because they did that at really low interest rates, we wrote a blog about this. We can reference it, or I could, send a link to it. But we just walked through the mechanics of bond prices. As interest rates go up, the price of bonds goes down, and so what's happened over the last 2.5 years, really in the last year, is inflation became a problem. November of 2021, the Fed finally acknowledged that, hey, we have to do something about this. They started raising interest rates last year, and we've gone from 0% rates at the start of the year last year to over 4.5% right now, which is, I mean, that is a historically huge move. But what it has meant is all the banks, you know, and I mean everybody, and even investors that bought government bonds over the last 3 years, the value of those bonds has gone down because interest rates have gone up. So flash forward to what happened at Silicon Valley Bank is they had really, really aggressively taken on a lot of deposits because they're really focused on the tech sector. And if you think about, you know, all the companies that went public and all the money that had come out of Silicon Valley over the last 3 years, that money, again, I mean, companies raise money, they have to put it somewhere, so they stuck it in the bank, a bank like Silicon Valley Bank, and they had taken in so much money that they had to buy so much bonds and everything, and they did a horrible job managing that. So basically, they had a lot of losses on their balance sheet, and last Wednesday evening, they came out and said, hey, you know, we just sold some securities. We're going to take a $1.8 billion loss, but we're going to raise some capital through the stock and bond markets to fill that hole, you know, and everything will be fine. But almost immediately, social media just blew up, and all the technology people, you know, that have money at Silicon Valley started freaking out and ended up pulling 25% of all the deposits, which is absolutely mind-boggling, in one day. So Silicon Valley, you know, just ran out of money, and the FDIC had to come in. They shut it down at noon on Friday. They said, we're taking this bank over, so it's no longer Silicon Valley Bank. It's, you know, part of the FDIC. And the last couple days has just been kind of the fallout from that, because another bank out of New York City had to get closed down on Sunday. And so it's just been, you know, obviously really, it came out of nowhere so much that, you know, it's just taken a lot of time for people to kind of get their heads around that.
Yeah. So a couple of things here. So that was one of the things I wanted to mention is all of this, when we talk about really big picture, it isn't surprising us because you've been writing about this for a couple of years. And when I say that it isn't surprising us, not this specifically, because we've been sensing that things are just too rich, too good. There's too much cash out there. There's so much money. And so we've been sensing that things need to tighten up. So that's why I say when it's not surprising us. However, when, you know, everything's so good, you don't really know all of the awful things happening underneath that should never have happened, the ways people are investing, what companies are doing, so things like that. So this is what we're really starting to find out, what was really happening when everything's so good and you can gloss over it. So when I say it's not surprising to us, these things, though, like what exactly is going to come out and all these things, that's the stuff that we don't know. And so, yes, it's surprising because you're never going to know the extent of it until it happens.
Yeah. And I mean, the one point that is really important to make right here, though, is no depositor of Silicon Valley or this Signature Bank out of New York, nobody is losing money. So, I mean, depositors, there's FDIC insurance in place for a reason. That was put in place in 1934. During the Great Depression, because there was this problem. There wasn't a guarantee from the government of depositors. So after the crash of 29, people started pulling their money out of the bank because, you know, it's like, I want to get my hands on it. And it just became a self-fulfilling prophecy at that point. So the insurance is there. It works. They've never not paid out 100 cents on the dollar for all FDIC insured deposits. So the good thing is, I mean, that is not an issue. I mean, money in the bank, FDIC insured is not an issue whatsoever. As you mentioned, though, I mean, it is, you know, this is what we're seeing right now is just a consequence of we had 0% rates for so long. I mean, really, you know, from the great financial crisis of 2008 through last year, other than a brief period in like 2017 and 2018. But I mean, it has just been a 0% interest rate party for so long. And, what we've written about the last couple of years, I mean, you don't know what's going to happen, but I've used this quote before from Warren Buffett. When the tide goes out, you find out who's swimming naked. You never really know what that is going to look like. Bank failure, I did not see that coming, but there's been enough signs and enough, I guess, enough going on with like people taking on too much risk. You look at crypto blowing up the last couple of years and, some of this really risky stuff. And, it was just like, at some point, this is not going to, when rates go up as they are, something is going to break. We don't know what that's going to look like. But yeah, I mean, we've taken actions over the last 2 years in client portfolios to kind of deal with that.
Yeah, exactly. No, that's so helpful. And one of the interesting things, so you touched on it and you said, no one's losing money. So no depositors, for the bank. And even going into the weekend, before we knew what the Fed was going to do to step in and help this or to insure everything, it was never in question whether the people who had money under that $250,000 per depositor per account type, it was never a question of if their money was insured or if they would get it. But specific to Silicon Valley Bank was that a high percentage, over 90% of their depositors, had much more than the $250,000 FDIC insured amount.
Yeah, and I mean, that's really what caused the panic is because Silicon Valley Bank dealt with very, wealthy tech executives and companies. 93% of their deposit base was uninsured by the FDIC. So in that scenario, I mean, before the government basically told them they're fine. If you go back to Friday, Saturday, Sunday, I mean, these people had no idea if they were going to have access to their money come Monday morning. So that's really what I think caused the panic. Eventually, the government came in and said, all depositors will be fine. I mean, there's moral hazard to that is probably worth talking about on another video at some point. But basically, I mean, they insured everything. So, I mean, just to be clear, I mean, so that everybody understands how this works. When the FDIC takes over a bank, I mean, they literally on that day, they show management the door. So they're immediately fired and the regulators come in and they have management, like basically crisis response teams that are trained to do this. They come in, take over the bank, and then the next business day, they are open for business. So FDIC took Silicon Valley Bank in a receivership on Friday. Monday morning, they opened the bank. So everybody that had deposits there could walk into the branch, get money out, transfer it, do whatever they want. I mean, that is how FDIC insurance works. So, I think it's just important to kind of emphasize that because, a lot of times we don't deal with bank failures a lot and you're not, I mean, FDIC insurance is something you always see on the placards when you go to the bank teller. It's like, oh, everything's FDIC insured and all that. But, until you really get into a situation like this, you don't think about like, how does that really work? Well, this is how it works. I mean, if you have under $250,000, you're fully guaranteed. And the FDIC makes your money available basically next business day.
Yeah, no, it's helpful. And we always put that kind of like in a cash management section in people's financial plans. And even sometimes we're like, do we need this section? But we've seen over the past couple of years, we've just seen an increase in cash balances that people are holding for whatever reason, whether they're selling real estate and they're just holding on it because they also sense that, maybe I just want to keep things a little more safe. And so we've just seen that over the last few years. So that's why it's always important just to have as a reminder. Okay. No, this is helpful. So I kind of want to shift into just kind of like what we do. So just talking about, okay, now we know what happened. We're going to get into kind of what we've been doing. But let's just kind of pause really quick and just kind of just spell out like what do we here at Financial Design Studio do for our clients? Like what do we actually do? What does Schwab do? Because Schwab is also a bank. They have a banking side. And so we want to answer a couple of those because over the weekend you've jumped back into your bank analyst hat. You put that back on that you used to wear for years. And so you did a deep dive. Let's start there. Just kind of like a deep dive into Schwab Bank. You went through all their financials, footnotes and everything. And I mean, do you feel confident in Schwab as a company because they're a custodian for our clients?
Yeah. And yes, spent my weekend going through bank regulatory disclosures and all that. Was a lot of fun. But yeah, I mean, here's how it works with Schwab and FDS is like you, the client, you come to us, you have $100,000, whatever, and you say, please invest this for us. By law, I mean, we cannot personally take that 100,000, put it into our bank and invest it for you. We have to find you a custodian or you find a custodian who has those assets.
Yep.
So we, at no point can we ever move that money or do anything without, your permission, basically.
Yep.
So Schwab is really wears two hats for our clients. So they're the custodian for all your investments. So that is like Charles Schwab and Company. Like that is a distinct company that is separate from the bank and, separately capitalized and everything. Those custodied assets, as we invest them in various mutual funds, like even that is like those funds, those monies are segregated to those funds. So, it's not like Schwab can really, they can't legally go in there and like say, hey, we're going to use some of this money from this mutual fund that you guys invested in. Like they can't do that. That's what Bernie Madoff did. It's illegal to do that. There's a lot of regulations to stop that. So, so Schwab, the custodian, basically when we buy exchange traded funds or mutual funds or stocks or whatever that is held by Schwab. That's all separate, that's in that company. Schwab has a bank as well, Schwab Bank. And what the function of that is there's always money moving throughout Schwab. People deposit money, they move it out. We always hold, call it 1% cash in our client portfolios just to kind of address daily cash needs and things like that. That bank is a separate entity from Charles Schwab and Company. And so what Charles Schwab does is when there is excess cash in your account, it is getting swept into their bank where they then go out and they'll make loans and they don't do a lot of lending. They just very high quality mortgages, but basically they go out and buy government bonds and government guaranteed mortgage bonds. So like everyone, they do have unrealized losses in the bank itself, but they're so massively overcapitalized right now that even if you assume they had to take all the losses, they would still be above their regulatory minimum capital standards. And so I'm not worried at all about that. You compare, we talked about Silicon Valley Bank, 93% of their deposits were uninsured. 80% of Schwab's deposits are insured. That is one of the highest ratios in the entire banking industry. And basically what that means is, if you have money at Schwab Bank, 80 cents of every $100 of deposits is absolutely, positively guaranteed by the full faith and credit of the United States through the FDIC insurance. So, the risk of a bank run at something like that would be just inconceivable almost because there's no reason to worry about it. When we manage portfolios, this is obviously we've been over the last, call it 9 months or so, we've raised cash levels in our client portfolios to 20%. We did not leave all that money at Schwab Bank. What we have done is we have bought a government-backed money market mutual fund that only invests in short-term government funds. Schwab runs it. They earn a fee on it, but that has nothing to do with Schwab. So there's like another piece of Schwab. You have Schwab the custodian, you have Schwab the bank, and then you have Schwab the asset manager who earns 30 basis points to manage this fund. All those monies are separate, so they never get commingled. The bank can't take money from the asset management company, and the custodian can't take money from the bank. I mean, there's walls around all this. So, that's a very long-winded way of saying, that's how it works.
Yeah.
I mean, we're not at all worried about Schwab or anything. But it's really important to understand how these things work, because, it's really easy in this social media age. You just see people say whatever, and, it can cause unnecessary concerns.
Exactly. I mean, I know even in the past couple of days, there's been, smart advisors who will see information and they post this and like, oh, I can't believe this. And I've seen you comment to be like, this is wrong. This is absolutely misinformation. And so what I want you to understand is what Rob has just explained. The reason that we have used Schwab as a custodian is for all of these reasons. So as your advisor, we have the choice to decide, is it Schwab? Is it TD Ameritrade, Fidelity, Vanguard? Where is it that we want to custody your money, your assets? And so we've chosen Schwab for these reasons. So doing our compliance, all of these pieces, these are the things that we're always looking for on the business side to make sure that our clients are protected, not only by what we're choosing as investments for you, but also who we choose to do business with. And so these are not we don't just choose this just because. And so I hope that just kind of gives you some comfort in knowing these are purposeful decisions that we've always made in why we work with who we do. So Schwab basically holds client assets, and now we understand there's different pieces to Schwab, which is really helpful. So it gives us some comfort in knowing, okay, all right, so my money's in a good place.
And worth mentioning, there is not a single account that has cash at Schwab over the FDIC limit, not even close, because the one thing, the way Schwab makes their money is they pay you money for your deposit, and then they invest that in bonds, and they try to earn that spread. Well, Schwab Bank pays a pretty crappy deposit rate. It's 0.45% right now or something. So, we're always looking to kind of maximize our client dollars. So we've been moving that money out of the bank into these money market funds that are paying close to 4%, because, why are we going to leave money at Schwab Bank paying nothing when we can get 4% for, government guaranteed money markets? So,
that's super helpful.
Yeah. And it's actually worth, as I was kind of digging around Schwab's regulatory stuff, they actually lost 18% of their deposits last year because of this switch. But the difference between them and, a lot of other banks out there is, they knew that was going to happen. That is part of the Schwab strategy, is they're not going to pay you the best deposit rate like an Ally or Capital One or one of these other online banks. That's not their business model. They won't make money on a spread if they're paying you 4% for your deposit. So, their risk management team, as rates started going up, they see this. They know what's going to happen. They know, they've been in this business a long time. They've been around for decades. They've been through rate hike cycles, rate cut cycles. They know exactly how customers are going to treat their cash at Schwab. And they knew, and they had, had this modeled out, that we're going to lose a lot of deposits at the bank because we're just not going to pay the best rate. We know that money's going to move, but we're prepared for that. And they've handled it just fine.
And just in case you're wondering, if I'm at Schwab Bank, I'm only getting 0.45. Well, you won't be surprised if you go look at your checking account, you're probably getting 0.01% as well. Yes. So this is why we've been saying over the last year, we've done videos, we've written about it, to say, if you just have money sitting in your basic checking account, it is not earning what it can be. And so this is why we've encouraged people to be sure that you're in a money market or that emergency fund savings, that's why you have it. So you have money there if you need to get to it in an emergency, that it's earning as much as it can be. So that's no different than any normal bank in a checking account. You're not getting any interest. So,
and our clients that are in retirement right now, know this, that, 2 or 3 years ago, and we were in 0% interest rates, there was no difference between keep your money at Schwab Bank versus Ally or wherever. I mean, nobody was paying a good interest rate. But over the last year, as our retirees have needed cash and, have taken RMDs, the question has been, should we just leave it at Schwab or, and just kind of do what we've always done? And our advice has been, no, you know what? Actually, as we raise that money, it's best to just move it to Ally. You're getting a better rate there. You're going to use the cash at some point anyway. So, I mean, this is just, this is what we do. I mean, we're always looking to maximize the return that you get on your cash.
Yeah. And at that time,
investments.
Exactly. And at that time, like the money markets, like hadn't quite caught up yet. Now you're earning in this money market, what you can earn in Ally and their money market. So these things have caught up. So what I want to be careful is that, people aren't kind of like, well, if I could earn more there, you are earning over 4% in this money market. And so that's something like, that's what we're watching out for you. But the other thing is when we're talking about kind of those funds where we say put them at Ally or so, we're just naming Ally as one bank choice. Capital One is another great choice because they have money markets that keep up with what rates are currently at. The money that we're saying to put in an account like that, like a money market, is an emergency fund, which is typically 3 to 6 months worth of cash. So please don't hear us when we say, I don't have anything there and I need to be moving money. You could have money in your bank account. You could have money in the money market at Schwab. All of that is serving the same purpose. It's set aside if you needed something in an emergency. It's liquid and available, and we're not selling something at a loss like an ETF or something. So it's a money market that it's there, it's earning interest when and if you need it. So that's the purpose of that. So, okay, Schwab, we understand the function of how it works. Now, what does FDS do? So here at Financial Design Studio, when we are doing this video, obviously people know, hi, it's us. Like we're recording this. We actually are thinking these things. We, are doing the research. But when you're writing, you're actually writing. Like the articles that we are writing, the newsletter, we're not getting this from any outside source, third party. A lot of advisors do pay for subscriptions to actually get that content. We are writing our own stuff so that you're hearing our thoughts because we're the ones choosing the investments that you're invested in. So that's what you spend your time doing, Rob, is saying, okay, of all the money that we're investing for you, what do we want in bonds, stocks, cash? And you're actually saying, this is where we're going to invest that, and choosing within that, what bond funds should we own? And so over the last couple of years, you can kind of, I'll let you just kind of summarize like some of the big moves that we've made, but we're actually the ones making those changes, making those choices for you. This isn't something that someone at Schwab is doing on their behalf.
Right. Yeah. And I mean, at the end of the day, people, we run into a lot of people as like, well, why should I pay you, whatever to manage our money when I can do it myself? And my answer to that is, I can cut my own lawn, but, I look at the job I do versus, when I pay a landscaper, which I've done, have paid a lot of money for landscaping over the years. The difference is just night and day. And it's, that comment is not meant to be self-serving and like, give us money and we charge you and we'll do a better job. This is what we do. Every single day. And if we just go back a couple years, some of the big moves that we've made in client portfolios, almost, call it 2.5 years ago, we started moving some of the bond portfolios into inflation-protected bonds. This was before inflation was a big deal, but we're looking around and it's like inflation could be a big deal. So we want to, have some protection for our clients for that. So we did that. And then as we got into 2021 and inflation started to take off, we're looking around and saying if inflation keeps going the way it is, the Fed is going to have to raise interest rates. And if they raise interest rates, the bond prices are going to go down. So how can we protect client portfolios from that dynamic? And so what we did is we shifted a lot of your bond investments that were kind of like long-term bonds, like 10 plus years, into call it 3, 4, 5 year type bonds. And the point there was interest rate moves don't affect bonds that mature in just a couple years versus ones that mature several years into the future. So, we made that move in early 21 to protect from interest rate risk. At the beginning of 2022, we did some things on the stock side to de-emphasize, like some of the international stock exposure, real estate exposure. We put a little bit more into commodities because we are and continue to be worried about inflation. But probably the biggest thing we've done is in August, we actually, we're looking around. Stocks had a tough start to the year last year, but it had a really nice summer rally from the end of June through early August. And, we're looking around and saying, you know what, interest rates are up. And, I read enough history of cycles and, monetary policy tightening and things like that. Yeah, I mean, every story is different, but they are the same. And when you go through a big tightening cycle, stuff breaks. So, as markets kind of recovered a little bit last August, it's like, you know what, let's take 10% of, all the money that our clients have in stocks right now, and let's just move that into money markets. Because at that point, they were paying 2%. It's like you're actually earning something. So, there wasn't like this huge cost to moving your money in cash like that. And then the market had, not a great fall. And then early this year, like starting in December, January, early February, we had another big rally in the market. And we decided to move another 10% into cash. So, the reason why we do all that is because, we're just looking around and, just based on our own experience of investing for a long, long time, you go through cycles and, again, they don't always look the same, but they do rhyme. And, as things have just kind of developed over the last couple of years, and particularly in the last, call it 6 to 9 months with rates and inflation doing what they've done, we just made the conscious choice to really batten down the hatchets for our clients and, move money out of the stock market.
Yeah. And you've kind of said, I know we have a lot of internal conversations as we're talking about this on the team. Even when we're saying, okay, do we do 10? Okay, I feel like we need to do another 10. And these seem like big moves because normally we wouldn't be doing this. And you've said taking and putting 20% into money markets, this isn't a long-term thing. This isn't, we're not running away from things. We're just saying, you know what, let's take some risk off the table so that when things do get worked out, we can put it back to work in something that once we see that it's actually in a place where things can rise, where we're ready to put it back in. So we're not running to just say, okay, let's just keep this and hold it. We're having it there on hand so that when we're ready, it's just a quick, yep, this is where it's going. So
Yeah.
Okay.
Yeah. And that's basically what we've been doing. We've been concerned about what's going on. We've been concerned about inflation, concerned about the rate cycle. I can't predict what, I never in a million years would have predicted that we'd be talking about bank failures because the system is very well capitalized and very liquid after the financial crisis 12 years ago. But, you just look for the conditions. You look for the signs. It's like, you know what? We don't, it's from the days when I used to play poker. I mean, somebody told me once, not playing is a play,
Yes.
So, I mean, we always think about like, oh, I have to be in, I have to be doing something, whether that's buying or selling or whatever. But really, I mean, and I truly believe this, sometimes just standing on the sidelines and doing nothing, that is the best play you have. And I mean, that's really what we've tried to do over the last several months is, as we've kind of moved that money out of the stock market and into cash, is just basically like, I hate to say my gut or anything, but I mean, my gut has just been like something is going to break at some point, and we just want to protect capital and, and whatever happens, because I guess the conviction was something would happen at some point, but you never know what that is.
Yeah. And at the same time, we were also realizing that cash is an asset class. We're like, wait, cash is earning. So money markets were earning 2, 3, now 4%. So we realized this is also a place you can invest money. And so
Exactly.
it's sitting on the side in something, paying us something, with a good return for much less risk.
I mean, I think about it this way: if we're assuming 6.5% returns in your plan, and we're getting 4% guaranteed by taking zero investment risk, it's like, well, why wouldn't you do that? Obviously, as Michelle mentioned, this is not a long-term strategy because, people who sit in cash, you lose purchasing power. We have 100 plus years of history that demonstrates that. So, this is not like, just sit in cash and call it a day. The cash we've raised, our intention is at some point when we're more comfortable with where things are and how things are looking, that will be redeployed back into quote unquote riskier investments, i.e. stocks or corporate bonds, whatever that is. So it's not a permanent thing, but to be clear, we're not anywhere near at this point,
Exactly.
redeploying that cash back into the market.
Yeah. And at the same time, like this is where, when you listen to the news, when you're hearing everything going on, you're thinking everything is falling, but there's asset classes, there are investments that are actually doing well year to date. And so this is where we can't just take everything out, sit in cash, because there are other things that are actually doing well. So I know even just in this week, you were saying like bonds are up, or even in the day, they're up like 3%. So.
Yeah. I mean, long-term treasury bonds just today that we're recording this are up 3%. And I mean, this is really, particularly for our clients who are in retirement or nearing retirement, this is, if you're looking for a piece of good news, is last year, the reason why last year was so bad for investors is because not only did stocks go down, but bonds had their worst year in decades. Usually there's an inverse correlation between those two. So if one is doing good, the other is doing bad, and vice versa. The good news, if you're looking for a silver lining, particularly over the last week or so, is as these stocks have really struggled, good old boring U.S. Treasury bonds have been doing phenomenal. I mean, rates have come down a lot, bond prices have gone up a lot, and if you look at the bond portfolios for our clients, so, I just did the math and was sharing this with Michelle this weekend. When you do the math of what we hold in your bond portfolios, 53% of that is AAA, meaning it's government bonds or government guaranteed mortgage-backed securities. So there's no question as to that. Like, you hold that stuff to maturity, you're getting 100 cents on the dollar. So, you take, for a lot of our retirees are maybe in a 60% stock, 40% allocation. Like, that is your target allocation. Well, we've already taken 20% of that 60 and moved it into money markets. So effectively, you're, call it 40% stocks, 40% bonds, and 20% cash. But then within those bonds, half of that is government bonds, guaranteed, risk-free. So if you really want to think about it, if you're a retiree and you're in a 60-40 portfolio or 50-50, I mean, you add the cash, you add half the bonds, you're call it 40 to 50% of your total investments are in guaranteed, risk-free government paper. So, obviously, I mean, there's, you still own stocks and other bonds and all that, but I mean, this is probably as conservative as, we would really want to get it because, look, I mean, we could always be wrong about the environment. We could always, you can expect bad things to happen and maybe some good things happen. And it would be irresponsible of us to, stuff your money in a mattress and call it a day. So, but, just know that. I mean, if you're sitting in retirement and you're like, oh my goodness, what's really in my portfolio? I mean, 40 to 50% of it is government-backed, risk-free, 100% you'll get your principal on it.
Yeah. So I think the biggest thing I really want people to hear is what you're invested in is on purpose. It's being researched. It's being changed. We're not just sitting in things, holding them. We're not just buying a big aggregate bond fund for all of your bond needs. Rob has several bond ETFs that make up your bond portfolio for all of these pieces that he's mentioned here. And so I think those are the things that, when we talk about our clients are invested, that means you as our client, you own bond funds in these different ways that like we're describing. So that's on purpose because of where you're at in your situation. If you're in retirement, if you're still working, if, any of these things. And even as we've talked to you and, talked about your cash needs and how much cash you should keep, all of that advice is specific to you. It's for you. It's not this big, well, everybody says I should keep this. Like when you ask us a question, it is based on your situation, everything we know about you, tailored and customized for you. So I just want to be sure that we're really clear that we're investing for you, nobody else, no other situation. And that is our duty to you, is to take care of the money that you've entrusted to us so that when you need it, it's going to be there. Now, you don't need all of that money on day one of retirement. You need it to be there throughout retirement for the next 30 plus years so that when something comes up, it's going to be there. So that is what we're investing for. We know we're going to need some money today. Great, we've got the money market. Okay, and as time goes on, each year we make sure that that's there for you. So that is what I want to be sure that you're hearing loud and clear, is that these are the things that we're doing every day to make sure that that's happening for you. So I would say, if you're someone that says, hey, I've got questions, hey, what about this? Please feel free to email, call. That's what we're here for, is to answer those questions. And if you say, okay, hey, I actually have a lot of cash, or I don't, and I want to make sure that I have plenty if something should happen, we want to have that conversation with you if we haven't already. So please be sure that you're asking those. You're never bothering us. I know some clients will be like, oh, I hope I'm not bothering. I'm like, no, like that is what we're here for.
This is what you pay us for.
Exactly.
So, use us.
Please ask. Yeah.
Yeah. Please ask.
Yep.
That's why we're here. That's why you pay us.
Yeah. And it's
for this.
Yeah. And it's okay to tell us if there's something that you're afraid of. It's okay to say, I'm worried about this or this. And that's actually what we do want to hear, so that when we're investing for you, we can invest for you, and we can know that so that you can help feel at ease about your portfolio. So that's everything we want to know. We want to hear that. So don't feel like you're going to scare us. Don't feel like we aren't thinking all of these thoughts ourselves. That's why we're a team, and we have these conversations together, and we say, wait, but what about this? And so that's what the result of this video is a lot of those conversations. So I just want to be clear about that. And then, so kind of where do we go from here? And I think the big message for this video today is that we know there's a lot of news that is out there. And even today you're hearing about Credit Suisse, another financial institution. These are things where what you hear in the news sometimes can be a little over dramatic. It can be, it can make you fearful, the way it's said, the way it's, whatever is said, and the way that news can be shared. What we want to be sure is that when we take a step back, this is why we're explaining, this is what's happening, this is what has happened, this is how we're protecting you, is that we know that news can move really fast, and sometimes it's hard to understand and take that in all at once because we're not quite sure, we don't have all the information right away. What we want to be sure of is, as news can travel fast and you can be watching whatever it is that you watch or listen to, we want to be sure. That's why we say ask questions, because we want you to not be fearful, to not worry. That's why we're explaining a lot of these things. But also just be thoughtful of that too. I know sometimes hiding under the rock is a good place to hide because you don't know everything that's going on that we're explaining. You're fine. But if you know everything and you're hearing a lot of bad stuff, it can just drive that fear higher. So what I want to be sure is just to calm those fears with this information we've given, but also just realize news does move really fast. Things can happen fast because the bank last week, they needed to get a solution. And so all of the news, stories were covering that. What's the solution? Okay. There's fear. Now there's not. So we just want to help kind of like lower a lot of that, kind of calm that. And if it is helpful to just reach out so that we can do that, sometimes you need that on a frequent basis. So just be sure. That's the biggest thing, is we realize news happens fast, and it's hard to sometimes understand or digest quickly enough to calm your fear. So that's the biggest thing, is please ask. So I guess from here, Rob, I think this week or next week we're going to hear from the Fed.
Yes.
Of what are they going to do? They're trying to fight inflation, but if they keep raising rates, isn't that going to make everything worse? So what's your sense of kind of where we go from here? Not that you're going to, the answers, but
yeah. If I did, I wouldn't be working
Right.
here. I'd be trading
Exactly.
on my own. But no, I mean, it's a week ago today. So, I mean, last Wednesday, everybody was expecting the Fed to hike interest rates. They have a meeting on the 21st and 22nd. So they'll announce on the 22nd, here's what we're going to do with interest rates. A week ago today, everybody thought they were going to raise by half a point. So like 0.5%. Because inflation has been very, very sticky. The job numbers the last 2 months have been really, really good. So the thought there, if the Fed is fighting inflation, they need, this is going to sound terrible, but I mean, they need to basically generate an economic slowdown. They need to generate some level of unemployment to kind of bring the economy off the boil. So a week ago, people were saying half a point. Then this weekend hit, and Monday, Tuesday, people are saying, well, maybe they'll only do a quarter of a point, so 0.25%. I really have no idea. I mean, it's the thing that has been shocking to me is the speed at which bond yields have collapsed over the last 4 business days. So if you look at like 2-year treasuries, last Wednesday they were yielding almost 5.1%. They're down to 3.8% today. To put that move into context, from people I follow that really kind of dig into, interest rate history and all that, I mean, that is the largest move that anybody has recorded. People were saying on Monday that it was the biggest move since the crash of '87. We've surpassed that now. So, I mean, it's the bond market has completely priced out any increase whatsoever. Knowing the Fed, I mean, they obviously have an inflation problem still. They're going to want to raise rates, maybe by a quarter. But I think if the bond market continues to push yields lower, there's no way they can do that because the Fed does not like to surprise the market. And if the market is saying no hike on the day that they have the meeting, they're not going to hike. I seriously doubt they're going to do that. The big question is where do we go from here? And that I mean, that's a topic for another podcast because it's the Fed is painted into a big corner because inflation is a problem, and if they start going down the road of cutting rates and saving the system, that problem is only going to get worse. Yeah. And, as we learned in the 1970s, the Fed, was feebly trying to fight inflation in 73, 74. They didn't have the commitment to go all in and do that. Inflation came down, but then it came roaring right back in the mid to late 70s. So that is the experience the Fed wants to avoid. But, we're dealing with a situation. We had 0% rates for 15 years. A lot of people did really stupid stuff, and we're just finding out in the last week some of the stupid stuff that people did.
Yeah, and I kind of feel like this is almost like a parent when it's like you have to wait until the parent has finally had enough and is like, no, there's no more. So we've had low interest rates, and then they started to increase them, but then COVID happened. So wait, we can't do it yet because people need cash, again. So we're back to lowering. And even with a drop from the banks this weekend, you still have people saying, okay, well, I'm going to invest this cash. There's still a lot of people that are willing to take risk and to put that money to work, investing it, even when we get these small drops on things like this. The Fed has to get rid of all of that in the system. They have to be this parent that says, no, there is no more cheap money. You have to run your business how it should be run. They have to get to be the parent that says no. And until we get to that point, where there's no more people out there saying, oh, I'm willing to take risk, and they have this risk appetite. I mean, we've got to get to that point where this is all worked out, and, there's a lot of things that will happen along the way, because if companies can't keep borrowing just endlessly, that means they can't keep hiring or keep the people hired. There's a lot of pieces like this that come with that. But we have to get to this point where the Fed can finally be the parent saying, no more. We have to control inflation, and, takes away some of these ice cream sandwiches that are out there,
right,
and like that's what we have to get to.
That's basically what it is.
And so that's where we're like, that's when we say like we don't know what's going to happen. We've got to get to that point, and so that's where we don't know what it's going to take to get there, or what the Fed will do, because they want to fight inflation, but they want to make sure people are confident in that their money is available when they need it. And so that will surpass, or that will be more important than fighting inflation for today to kick that inflation can down the road, but it has to be addressed at some point. So
and I mean, that's what, again, I'll go back to that poker analogy of, you don't have to play the cards. And
that's great.
I think we're really content to just, we've got cash. Half our bond portfolios are government guaranteed. I don't think there's really a need to make some dramatic move yet. Prices will dictate that. If the market were to go down a lot, the conversation might be different. But, I think at this point, and I learned this hard lesson, back when I was analyzing banks and all that. Being too early on something can be really, really painful. And, I remember, I had foolishly recommended buying a bank in like late 2007 because I'm like, well, things look bad, but it's not that bad. And it took like, maybe 2 or 3 months before I realized what a stupid recommendation that was on my part. So, it's just, we're just in one of those moments where you have to just kind of like stand aside, let the market play out. People who are over their skis are going to get exposed. And, once more of that stuff comes out, then the conversations around, okay, well, what, how are we going to go back into risk at that point?
Yeah, and exactly. Those are the things that's what as your advisor, you're paying us to do, is to learn from our experience, the knowledge that we've gained, the things we've seen, the people that we talk to. All of these pieces make up our advice to you. And, Rob, one of the things is like you learn from something that you've done in the past.
Oh, yes.
When we're starting to find out about this as the Silicon Valley Bank, there's a lot of people that have been involved in other debacles like this. So clearly they haven't learned. These are the things that, rest assured, when we realize we've done something, when we've learned something from earlier in our career, you're benefiting from the knowledge of that and the experience to say, wait a second, we need to step back. And so that's what I appreciate about our team, is that you get a really well-rounded voice, because we're all talking to each other and we all are reading and following different things. And so all of that gets brought out into a conversation like that. So this is really the result of that. But please let us know if you have questions. We hope this has been really helpful to kind of address where we've come from, what we've done, where we're going, and then what we see ahead. But I envision we'll probably have, another video like this in the future, kind of just updating you where we're at. But that was the purpose of today. So thank you for joining me, Rob. This has been really helpful.
No problem. Well, emails, as things develop and change, we'll continue to be in communication with everyone.
Yeah, exactly. All right. Well, thank you so much. And let us know what questions you have. So this was just an example of the communication that we share with our clients and the advice that we're giving them. This is information that you want to. You're in a situation where if you aren't working with an advisor, or you are, these are the same questions that you have. So we hope this has been helpful to address a lot of that. If you're looking for an advisor, a second opinion, or you just say, you know what, I should be working with someone. I don't know all of this, and I realize that. Please head to our webpage, financialdesignstudio.com, and as always, you can watch YouTube videos or blog posts that we've written about. We're going to link to a lot of those in the show notes, so you can see those as well. But until next time, thanks for listening.
Thanks for listening. To find any links or resources related to this episode, check out our show notes. Your host was Michelle Smallenberger, a certified financial planner and CEO. The guests featured are from Financial Design Studio, a team of experienced, fiduciary, fee-only advisors based in Chicago. Anna Lewis is the executive producer of the Behind the Designs podcast. And as always, for more information about Financial Design Studio and who we are, check out our website, financialdesignstudio.com. And final note, no content discussed on this podcast should be taken as financial advice. Financial Design Studio accepts no responsibility for your individual choices. We'll see you in the next episode.